What's going on, ladies and gentlemen? Welcome to the Crusaders Castle here in Carrollton, Texas. I'm going to go over some things with you because I've had some questions from you guys reaching out to me. I wanted to go over some stuff, clear up everything. So today I want to go over with you the 3 ways that money grows. Okay? There's only 3 ways that money can grow and work for us. First 2 ways are probably going to look familiar to you, but the third way is going to be something completely new. So the first way, most of us, we go out and we get a job. When we get that job, we have to have a place to where we get our direct deposits put into, right? So we go out and we open up a bank account. Now, the bank account is known as what's called a fixed strategy, meaning the growth looks like this. Anywhere across America, it's 0.03 to 0.06%. But why do we like the bank account? Well, we like our banks because our money remains liquid. We have access to use it whenever we want it. We also like the fact that it's safe, secure, it's FDIC insured up to $250,000. Now, why do we not like our bank account? Obviously, the growth, right? So we don't like our bank account because there's not very much rate of return. Have you guys ever heard of the rule of 72? Google it if you have a chance. So Albert Einstein said that the rule of 72 was the 8th wonder of the world. And he said that if you take your current interest rate and divide it into 72, it would tell you how long it would take for your money to double. Now, for the sake of illustration purposes, let's just say you're getting a whopping 1%. And you got $1,000 in your bank account. Well, 1 into 72 is still what? 72, right? So it would take 72 years for your $1,000 to grow to become $2,000 if you had a 1% interest in your bank. Do you have 72 years to wait around on your money to double? I know I don't. So that's when we have to take a look at a different strategy. Now, typically, as middle-class Americans, W-2 employees, we go out, we get a job, and then HR approaches us. And they say, all right, Mr. Employee, you've made it here for a week, 3 weeks, a month, whatever the period of time is necessary for now you to have what benefits are. And they say, we got this great company match 401k. You're going to love it. Now, what they don't tell you is that it's a company match so that your employer takes a tax deduction every year for the amount of match that they put in. Essentially, they're passing the taxes off to you. Now, I don't say just stop putting into it, because it's nice to diversify your portfolio. I do have clients that select to no longer contribute to it and then redirect what they were putting in into something more beneficial. We'll discuss that here when we get to number 3. But if you're still wanting to contribute to it, you can still do that. Just don't go anything over the match. Diversify into something else. But that's known as a variable strategy. Now, variable is exactly how the name sounds. It goes up, it goes down, it goes up, it goes down. It's an emotional roller coaster with your hard-earned money. Now, we like the variable strategies because, yes, there is upside growth potential, but there is also what? There's also a 100% risk of a loss. You just don't know how much or when that's going to occur. So the variable strategy, this is where your 401ks, your 403bs, your thrift savings plans, your IRAs, your 457 deferred comps. This is where these are all located. It's all tied up into the stock markets. You don't have any access or control over this money without heavy fees and penalties because it's in the stock market. And these are what's known as government-controlled qualified plans, meaning you're entering into a business partnership with Uncle Sam. And since this is a government-controlled plan, the IRS is saying, okay, we're not going to tax you on the $10,000 right now while taxes are at an all-time low because they're tax-deferred accounts. We're going to defer taxes till later on down the road when you're older in life, you want to retire, and we're going to tax you on that $100,000 in your retirement. Oh yeah, by the way, that's when we'll tell you how much we're going to tax you on. Well, do you guys think taxes are going to go up, down, or stay the same in the future? Let me know in the comments section. I, for one, think they're going to go up. With our current administration that we have, taxes have only got one way to go because they spend everything that we give them. So if you are like me and you're thinking taxes are going to go up in the future, I 100% agree with you. Does it really make sense to have our hard-earned retirement vulnerable in market losses and pay higher taxes later on down the road? I see some light bulbs going off. This is exactly why I entered into this industry and said, you know what? There has to be a better way out there. People need to know, what do the wealthy do? The top 5% of the wealthy in the United States, they don't rely on just these two. There's something else out there. So what do people like Donald Trump do? What do people like Hillary Clinton do? What do people like Grant Cardone, Robert Kiyosaki, Patrick Bet-David, what do they do? Well, when you start looking back at history, what did Sam Walton do when he started Walmart? What did Walt Disney do to start building Disney World in Florida? They leveraged life insurance. So this third strategy is known as the indexing strategy. Indexing looks like this. You're able to capture the upside growth potential of the market just like here. However, unlike here, where you're susceptible to the losses, in a down market using the indexing strategy, you have a 0% floor. So you level. You may not make anything this year, but you're guaranteed never to lose. Then when the market rebounds, because it does, do you have the years it's going to be necessary to now get back up here to where you were before the market did a downturn? Or would you rather pick up right where you left off, allowing you to experience uninterrupted compounding interest of the market? Now, the people here, the advisors and the people on Wall Street, they're going to say you have compound interest, and you do, as long as you don't have any of the downturns. But the power of uninterrupted compounding interest, you never experience any of the downturns. Now, why do we like the indexing strategy? Let's look at it. So indexing strategy, your money remains liquid. You still have access to your money. Okay? It's safer than the bank accounts because it's asset and probate protected. What does that mean? That means nobody can sue you for it. That's why a lot of doctors, dentists, lawyers, chiropractors, governors, senators, congressmen, ex-presidents, their money and their wealth is building in these types of accounts. Because if they were to get hit with a lawsuit, nobody can sue them for their wealth building here. They can get these. Your retirement money, they can get that if you get hit with a lawsuit. They can get your bank account. They can't touch this. Another reason we like it is since we're experiencing the gains without any of the losses, we have excellent rates of return, typically anywhere between 6 to 12% annually. Your gains are locked in annually as well. So your principal is never at risk. Your gains are locked in annually. There's an added bonus. With the indexing strategy, you're thinking, I know exactly what you're thinking. This is too good to be true. It's governed by a tax code, 7702, which states that you have access to your money while it's compounding in this particular financial tool, 100% income tax free. So you have access to your money without Uncle Sam touching any of it. This is exactly what Robert Kiyosaki explains in some of his books, like Rich Dad, Poor Dad. There's a reason that middle-class America was not taught the indexing strategy, is it does not benefit three major entities. That's the banking system, Wall Street, and the U.S. government. Those are three entities that do not want you to have control over your money. They want you to comply. There's a reason that the Rockefellers, John D. Rockefeller, took financial education out of the school system. He said, I want a nation of workers. I don't want a nation of thinkers. So they took financial education away from us. They don't want you to know this strategy because it doesn't benefit anybody but you. It doesn't benefit anybody but you and your family. If you're wondering why the rich keep getting richer year after year, if you're wondering why the rich get richer generation after generation, they pay less and less taxes. This is how they do it. It's all in what's known as a properly structured, designed and engineered permanent life insurance product known as an Index Universal Life. Before it was Whole Life. Whole Life's been around for a long time. This product came out in 1997. Once this product was released in IUL and the wealthy learned how to structure it for their benefit, they didn't get a life insurance policy for death any longer. They got life insurance policy like this to put their money to work for them and have access to it tax-free. Because let's look at what the banks do. The banks use a policy like this as well. Okay, it's known as BOLI, bank-owned life insurance. Big corporations, Wall Street, or not Wall Street, Whirlpool, Walmart, McDonald's, these big C-suite executives, they use this type of strategy as well. It's called COLI, corporate-owned life insurance. You can look up bolicoli.com and find all the facts and figures about it. But there's a reason that the banks do this, because they create velocity with your money, not their money, your money. Let's do this. So here we are, good little employee, W-2. We're putting our money in a bank. The bank, for every dollar that we put into a bank, they loan it out 9 times. 1, 2, 3, 4, 5, 6, 7, 8, 9. So you put in $100, they loan out $900. You put in $1,000, they loan out $9,000. The other percentage, they put in what's called Tier 1 assets. From this Tier 1 asset, they are now capitalizing on 6 to 12%. And they're getting that credited back to them. Now, the rest of these are auto loans, boat loans, mortgages, credit cards, motorcycle loans, business loans. So they're getting credited all that, plus this Tier 1 asset that never loses. It's a life insurance policy. They're able to capture the gains, never any of the losses. So it's just stair steps, uninterrupted compounding interest. They still have access to this money. Now, have you ever gone to a bank and let's say you decided you wanted to pull out $15,000 in cash? So here you go, Mr. Bank, can I pull out $15,000 in cash? They're going to say no. Will a cashier's check work? And if you're a farm boy like me, where you deal with cash, with buying tractors, implements, trucks, trailers, that kind of thing, no, the old timers, they don't like cashier's checks. They want cash in hand if you're going to be buying an old tractor or a piece of equipment from them or some livestock. So if you need $15,000 in cash, they're going to say, okay, well, we need to order your money. You're going to have to come back next week to get your money. What does that mean? They're not ordering it from a bigger bank. What they're doing is they're going to leverage this Tier 1 asset and pull out this $15,000 as a loan against the policy. It's going to take anywhere from 48 to 72 hours to go from the policy back to their account. And then it's going to take another 24, 48 hours to go from their account to your account for you to pull it out in the form of cash. That's why the banks tell you we're going to have to order your money. It's not from a bigger bank. It's from they have to have time to move the money around. Okay? You can do this as well. You cut them out as your middleman. You, instead, this is going to change your life. It changed mine. It changed my family's life. This is why I teach this. This is why I license other agents to go and educate this and properly structure policies for clients. Okay? You change this one thing in your life, it's going to make a world of difference, I promise you. Instead of you putting your money here, use your bank as a pass-through. What does that mean? That means you're going to go and you're going to put your money, most of you are direct deposits, right? Your money's going to go here, your bank account. You're going to have a set premium going into your own Tier 1 asset in the form of an IUL every single month. Now, this set premium, depending on how old you are, let's just use me for example. I'm 35, okay? So let's say you're 35 years of age. You're going to be putting $350 per month into this policy as a set amount. Now, let's say you want to be able to overfund it 1,000. You're going to log in once a month and put 1,000 extra into your Tier 1 asset. Now you have $1,350 per month going into your IUL policy. Now with this IUL policy, yes, it is life insurance, so ultimately you're going to have a death benefit. But you're also going to have cash value accumulation into the policy with that uninterrupted compounding interest. You're also going to have access to it tax-free while it's continuing to grow. Now, it took me a couple of years to get this built up enough to do this, but this is a strategy known as infinite banking where you're becoming your own bank. The more you overfund it over the amount of premium, the faster this thing is going to grow. It's a snowball effect, okay? The faster it grows, the more you overfund, the faster you have the access to your money tax-free to live off of. Tax-free living. What you're doing is you're going to go out and you're going to get a credit card. Okay? This credit card that you get, you're going to get this particular credit card with what you intend on doing. I travel a lot for business. So I have a credit card that gets me flyer miles rewards, hotel rewards, rental car rewards, and I'm living off of it every month. Once a month, I take a loan from myself from my IUL. We're not taxed on debt. You learn this in the Rich Dad, Poor Dad book by Robert Kiyosaki. So since we know that we're not taxed on debt, I'm taking a loan from my private bank and I'm borrowing not from my cash value. I'm going to teach you how to leverage. So we're leveraging the cash value that's growing uninterrupted in the policy, and we're borrowing from the future death benefit. So let's just say we have 25,000 in cash value. We have 100,000 in death benefit. We're going to leverage this 25,000 against the 100,000, and we're going to request a loan from ourselves. Since it's a loan against ourselves, there's no paperwork you have to do. There's no approval that you need. You're going to log into your policies portal and you request a loan. The carrier is going to log in and say, okay, you've requested a loan of, let's say, $5,000 to pay off the credit card for this month. You requested a $5K loan. You have $25,000 in cash value. We're going to loan you that $5,000 from your future death benefit so that you can pay off this, and you're just going to wash, rinse, repeat, do that every single month. That's infinite banking. And the reason that you're doing that is because you're still putting into it, you're paying it back, but you're paying it back to yourself, plus you're still growing in cash value every single year at 6 to 12%. You're creating velocity with your money. It's exactly what the banks do with your money. You're just doing it for yourself. Now, instead of your money working for the banks, your money's now working for you. So this is a strategy. That's all it is. You can't go to a life insurance agent and go, I want to set up infinite banking, because they're not going to know what you're talking about. They have to be properly versed and licensed and trained on how to do this. Because if you set this up incorrectly, it's going to be based off of commissions, and it's going to be lining your agent's pocket. So you have to have an agent that knows how to structure IULs to benefit you and your cash value growth. So if you go and you say, all right, you're my licensed life insurance agent. You do my home, my boat, my auto, my motorcycle. I want you to do my life. Great. They're going to educate you on a term policy or a whole life policy. Here's the differences with whole life, because if you say, I want a permanent policy, they're going to talk about whole life. Here's the differences. Whole life versus IUL. Okay? Whole life, it's going to cover you till you're 100 years old. It is a permanent policy. That's what it's considered. It does have cash value accumulation, but typically with a whole life policy, it's capped at 2%. Whole life policies also do not have what's called living benefits. Now, living benefits, that states that if you get diagnosed with something that's a critical, chronic, or terminal illness like heart disease, cancer, stroke, even Alzheimer's, you'll have access to a portion of your death benefit to use while you're alive. Whole life does not have that. Let's look at IUL. IUL is going to cover you till you're 120 years of age. It is considered a permanent policy, but it's also looked at as an asset by the banks. So for instance, if you have a mortgage, your bank is going to see if you have a life insurance policy in place to cover the amount of mortgage. They see this as an asset because it is a cash value accumulating policy, and it does have a death benefit. The whole purpose of an IUL, though, is to have a minimum death benefit to maximize cash value growth. Okay? So you want a minimum death benefit to maximize your cash value growth. If you have a high death benefit tied to a policy that's an IUL, that's not good. That means you had a bad agent. They structured the policy to line their pocket, not to benefit you. Because the cost of insurance is going to increase every single year, especially once you reach the age of 65 or 70 years old. The policy runs a risk of eating itself if it's not properly structured. So you want to make sure you have a minimum death benefit, maximum cash value. Very rarely do we do target premium unless they are an older client and they're wanting a certain amount of coverage or a certain amount of premium to put in every single month. These things can be structured a number of different ways, guys. You have to be able to, as an agent, structure this policy for what the client is intending on doing. The reason the IULs exist is because you can structure them in the form of infinite banking. You can structure them in the form of a college fund. And you can also structure them in the form of what's called a LIRP. Now, LIRP, the majority of IULs that I do, not everybody qualifies for an infinite banking strategy. Okay? This is not something that you can do setting aside $100 a month, $200 a month. The whole purpose of an infinite banking strategy is to set it up for whatever age you are at a zero and then overfund it, max fund it. Okay? That's infinite banking. College fund is if you have a child and they're younger than 18 and you're setting aside anywhere from $50 to $150 or $200 a month until they're 18 or until they're 21, and then they can either elect to take over payments or they can use that cash value for college or to start a business. They have capital. A LIRP is if you are a certain age, let's say you're 50, add a zero to it, 500, you're going to put $500 a month until you're 65 or 70 or 75 years of age, depending on how long you want to go out or what age you are or you're wanting to retire at. You're going to fund it until you retire. And then after you retire, you're no longer going to fund it. It's still going to grow with uninterrupted compounding interest every single year, 6 to 12% annually. And then you're going to start having distributions. It's going to solve for income. And it's going to make sure that you have income until you're 120 years of age. So what that does is a LIRP takes longevity risk off the table. You'll never run out of money during your retirement years. Okay? That's what these accounts are for. They're not to solve for death benefit. That's why we do blended policies. Blended policies meaning, okay, I want an IUL in the form of alert to diversify my retirement portfolio. But with that death benefit being a minimized death benefit, well, with my mortgage, with my 2 cars, with student loan debt and my credit cards, that's not going to be enough to cover my expenses should life throw me a curveball and I pass away. I don't want my kids to succumb to that or my spouse to succumb to that. So I'm going to blend an IUL policy with a 30-year term policy. Okay. Now, a term, we like term policies, they have their place. Okay. I'm going to walk through a couple of term policies. There's 3 different types of life insurance that you can get. Okay. So the first type of life insurance is term. We like term because term gives us the most amount of death benefit for the least amount of cost. Okay? So term is great for when the income maybe isn't the best and your monthly expenses, you have a lot of outflow but not so much inflow, but you still want to have something in place. Term can cover you from 10, 15, 20, and 30-year increments. With the term policies that we have, term policies do have living benefits, meaning if you get diagnosed with anything, you're going to have access to a portion of your death benefit to use while you're alive. Term, just like the name suggests, though, after the 10, 15, 20, or 30 years, it ends. And let's say you're paying $30 a month. Well, now that $30 a month, that large amount over that time frame, that goes to the carrier. They get to keep that for covering you with death benefit coverage and protection. Now, there is a different type of insurance known as an ROP. ROP is a 30-year term, a little bit more expensive. Let's say it's $100 a month if you're in your 30s. Does have living benefits, but it has something else as well. It has a refund, because an ROP is called a return of premium, meaning this $100 a month that you're paying into this for 30 years, yeah, at the end of that 30 years, you're going to be older. You may be susceptible to underlying health conditions. You may not get approved again for another policy. That's the risk that you run with a term and an ROP. But I use ROP policies as a form of mortgage protection for a lot of my clients. That's why I blend an IUL for retirement structured in the form of alert with an ROP structured in the form of mortgage protection. Because most mortgages are 30 years. If you have a 30-year term policy, you don't see this money coming back to you. But if you have a 30-year ROP policy, that means that after 30 years goes by, this amount of premium, let's say 100 times 30, this 30,000, now comes back to you in the form of a refund, tax-free. Now you have a paid-off home. You could remodel the kitchen, the bathroom, or maybe just take the family out on a nice vacation. That's why I blend policies with IULs in the form of return of premium. 30 years worth of coverage, good amount of death benefit, living benefits in case life throws you a curveball, but you have that IUL that's in this realm. Permanent. Permanent policy is going to cover you either until you're 100 years of age in a whole life or 120 years of age in an IUL. Okay? Whole life IUL. The IUL is going to have living benefits. The whole life policy is not going to have living benefits. The whole life policy is going to be capped at 2%. The IUL is going to have 6 to 12% growth. Neither are going to be susceptible to any losses. But which would you rather have? Another main difference between a whole life versus an IUL is a whole life, only the death benefit will pass to your beneficiary. Okay, so if it's a $500,000 whole life policy, doesn't matter the cash value growth. The cash value, let's say the cash value is 100,000, and the death benefit is 500,000. When you pass away with a whole life policy, only your beneficiary is going to get this 500,000. This 100,000 is going to go back to the insurance carrier. Now with an IUL, it's different. With an IUL, you have death benefit protection plus your cash value accumulation goes tax-free. To your beneficiary. So which would you rather have? Would you rather have a $500,000 going to your beneficiary and the insurance carrier keeping the 100,000, or would you rather have your 100,000 in cash value blossom a few $100,000 more, and then in the form of a death benefit go income tax free to your loved ones? Which would you rather have? So those are the differences. Whole life, IUL, those are the difference between term, ROP, permanent. This is exactly what we teach our agents to go out and educate middle class America on, because right now there's nobody out there doing it. Think about it. For those of you that actually have life insurance, which it's not a high number, guys. Most people out there in America today don't have any life insurance, and over 80% of them don't have a significant amount of coverage enough that would actually be beneficial for them and their family. Over 50% of them don't even have living benefits in the policies that they currently have. So if you'd like to learn more about these types of policies, more about these strategies, see what one would look like specifically for you and your family, go ahead and click the link in the bio of this page. I'm streaming across multiple platforms, so I can't see you guys' messages, but I will be reading you guys' comments down below, and you can feel free to DM me, shoot me a DM on any of these platforms. You can go to the profile, you can click the link in the bio of this platform, and you can schedule a free consultation directly with me. You can pick a date, you can pick a time. We can hop on a Zoom call. I'm licensed in 28 states across the nation, and I represent over 400 different national life insurance carriers. So I look forward to speaking with each and every one of you. God bless you. Have a great Friday evening. We'll see you.